Hi, I'm Jeff Hirsch. I'm here at the Money Show in Dallas with Mike Turner. He's the president of Turner Capital Investments, which is at turnercapital.com, right?
Yes, sir.
So tell us about the business. What do you do for clients? How does it work? How do you assess their needs?
Very simply, I manage money for folks, and I do it based upon math. Not on guessing, not on the fact that I might know something that's really, really different from everybody else in the way of what the stock's going to do or an ETF is going to do. I measure everything based on where the market is, and I put my clients' money to work accordingly. The money is held at TD Ameritrade. That's where the clients.
A lot of people use it.
A lot of people use it. It's a great. It's a great brokerage firm, and basically all it amounts to is this: you would look at the three different models that I've got. I've got one that just is the S&P 500, where I trade the SPY in a bull market, the SH in a bear market. I've got one called Tactical Growth. It's got stocks in a bull market. It's got 4 inverse ETFs in a bear market. And then I've got one called an Ultra, which basically means that it's going to go twice as fast up in the bull market as the S&P does, and goes up twice as fast as the S&P goes down in a bear market.
So how do you decide which model to put a client in?
Well, I have to talk to the client, because the client has to decide how much risk they're willing to take. Okay, there's more risk, and here's how I measure risk in these models. All has to do with the likely maximum drawdown. So if you're in just the S&P 500, the maximum, and by the way, I've never had a losing year, so I've not had a real drawdown on any of them. But on a short-term drawdown, the maximum you could lose in the SPY model is about 4.5%. So that would be a worst-case scenario. Why? Because we put stops on everything. Our stop-loss strategy is what keeps us from losing a lot of money in any direction. I make the assumption, by the way, that whatever trade we put on is wrong. But the market's going to reverse, and I want to make sure
that's Talmudic wisdom, my friend.
It is. So what you have to do is always be protecting for that downside. And so I use stops on everything.
Right.
And the stops are based on one standard deviation of normal volatility of whatever I'm holding.
Right.
So it's basically
even for the individual stocks.
Individual stocks. Each one of them has its own stop loss personality, as I call it. Okay. So if you're in the tactical growth model, it's going to have a maximum drawdown of maybe 6 or 7%. And if you're in my ultra model, you could have a maximum drawdown of 10 or 11, 12%. Right. So it's basically depends on what the client wants with regard to how much drawdown, how much can they take.
Is there some way that you'd put somebody in all three different allocations?
I've got folks in all three. However, the majority of folks go into tactical growth and ultra. They'll put and it depends on their age, it depends on their lifestyle, depends on how much money they want to actually put at risk, depends on whether it's IRA money or 401k money or taxable money, all that sort of thing. So all that comes into play. So if someone is interested in finding out more about that, they just need to go to turnercapital.com and fill out, there's a dialogue tab at the top of the screen. Fill that out, and I'll respond to that person. I'll call them. We'll talk about it, find out what their financial situation is, and then we'll go to work for them if that's what they want.
Fantastic.
No obligation.
Thank you, Mike. Thanks, everybody.